Have you ever wondered why paying 1 million US dollars to acquire a company does not necessarily mean the investment is worth exactly 1 million on the books? In accounting, the timing of payment, special conditions, and the way you pay can affect the real cost. So today in this video, I will explain simply how delayed payments, possible extra payments, and paying with shares work when preparing the financial statements together. So cost of investment or the component of cost of acquisition. When you acquire a company, we can we can identify the cost of investment, or the cost of investment can be given in different ways. Now here I have given you 4 different ways where you can identify the cost of investment, or the investment cost can be given in different ways. So the first method is first possible method is cash payment or single cash payment. So this is a very straightforward method, the actual money paid at the date of acquisition. If you are given the actual cash payment, straight away you can get this value to identify the goodwill calculation. So basically when you calculate why you need the cost of investment or the consideration paid to identify the goodwill. So simply you take the consideration paid, compare with the fair value of the net assets acquired. Okay, if there is non-controlling interest, that also you need to take into consideration. Now the second possible way is deferred consideration. What does it mean, deferred consideration? Payment agreed today but paid later. Okay, so which means there is no single cash payment. The cash payment will be staggered, or it will be in installment basis, maybe more than 1 year or 2 to 3 years period the consideration will be paid. So at that time, to calculate the goodwill, you need to identify the current investment cost. So in order to identify that, since you are given a staggered payment or installment payment, what you need to do is you need to discount the deferred payment to identify the present value of the consideration paid. So in this case, this is measured at fair value at the acquisition date. Since payment is in the future, discount to present value. So you need to discount to the present value. For example, if you are given, I will discuss this in the next slide about the calculation part. And the third way is the contingent consideration. So what does contingent consideration mean? The payment made only if certain conditions are met. So this means, for example, let's say there is a sales target to be met. So once the sales target is achieved or met, the payment will be made. For example, let's say a company can agree to pay 100,000 US dollars upon achieving a sales target. So therefore, that possible way also can be given to identify the cost of investment. So this is also measured at fair value on acquisition date. Okay, and the fourth and the last, the final method is share exchanges. Okay, when the payment issues its own shares, when the parent issues its own shares to buy the subsidiary. Okay, so for example, the parent is acquiring the subsidiary company, and part of the investment cost will include the share exchange. Here the fair value of shares at the acquisition date is included in the cost of investment. Okay, so I will be discussing a detailed calculation with regard to this cost of investment or the component of cost of acquisition. When a parent company acquires a subsidiary company, the investment cost can be given in different ways in the questions. Okay, so stay tuned. I will discuss the questions relating to the cost of investment in my next video. So as you can see, the fair value of other consideration, the calculation methods are given in all these three methods. Now when you look at the deferred consideration, the payment agreed today but paid later, measured at fair value at the acquisition date. So we need to find out the fair value at the acquisition date. Since the payment is in the future, the discount, we need to discount to the present value. So this is the formula that everybody knows, this formula to calculate the present value. You take the future payment and divide it by the discounting rate and the number of years. So here the R means the discount rate or the cost of capital. It will be given in the question, and also the number of years until the payment is made. So this is how you have to calculate if the deferred consideration is given as part of your investment cost. When it comes to contingent consideration, the future payment only if conditions are met. So for example, subsidiary must hit a profit target. When the profit target is hit, the payment will be made. This is contingent upon the achieving certain targets. This is also measured at fair value on acquisition date. If the actual payment differs later, treated as a change in accounting estimate under IAS 8. Difference goes to profit or loss and affects retained earnings. So in this case, for example, the deferred payment is, or the contingent payment is upon achieving a profit is, let's say 100,000, but actually achieved let's say 75,000. That difference of 25,000 will be transferred to the profit or loss account based on this contingent consideration. It is allowed under IAS 8. And also finally the share exchanges, instead of cash the parent issues its own shares. The fair value of shares at the acquisition date is included in the cost of investment. So in this case also, when you calculate the share exchange, you need to identify the fair value. For example, parent issues 10,000 shares at a market price of $50 per share. So the cost will include, the investment cost will include 10,000 times $50. The total will be 500,000. Okay, so these are the different ways in which you can identify the cost of investment at the time of acquiring a subsidiary. Okay, so let's move on to a calculation part. I will discuss in my next slide. Okay, let's move on to this particular question. On January 2024, parent company acquired 80% of subsidiary company. The purchase agreement included the following. Now you are given the purchase consideration that consists of, as we discussed in the previous slide, different methods. Now you are given immediate cash payment of 500,000. So this is a straightforward method. So you can straight away you can take this amount 500,000. Then the deferred payment of 300,000 payable in 3 years time. The appropriate discount rate or the cost of capital is 8%. Now this 300,000 is payable in 3 years time. So therefore, when you consider the investment cost, this 300,000 has to be discounted over a period of 3 years. So basically we need to calculate the present value of this future payment. Okay, the future payment. So basically we need to apply the formula. So 1 divided by 1 plus 8 to the power 3. Okay, so basically that will be 1 divided by 1.08 to the power 3. So when you calculate that, that amount will be point 0.79383. Okay, so this is the discounting factor we need to apply. So basically that 300,000 has to be multiplied by 0.79383. So that amount will be, so when you calculate 300,000 times 0.79383, so that amount is going to be 238,149. Okay, so that will be the deferred payment. The present value is 238,149. Then third one, contingent consideration of $100,000 payable only if subsidiary company achieves a profit target in the next 2 years. At acquisition date, the fair value of this contingent amount was estimated at $60,000. So therefore, this is also very straightforward. You can take, since the fair value is given, so 60,000 can be considered when calculating the total investment cost. Then finally the share exchange, parent company is issued 50,000 shares to the former owners of subsidiary company on the acquisition date. The parent company share price was $4 per share. So therefore what you need to do to calculate the share exchange value, 50,000 shares were given at the time of acquisition. The rate was 4 per share. So therefore the total will be 200,000. Okay. Now the fair value of subsidiary company's net assets on 1st January 2024 was 850,000. These are the net assets, and also you are given fair value of the NCI on acquisition date was 225,000. So basically this is the non-controlling interest. So this is also we need to consider when calculating the goodwill. So calculate the goodwill. So basically, so you need to consider consideration paid. Now consideration paid is how much? Now this consists of the cash payment of 500,000, then deferred payment of that we already calculated, 238,149. Then contingent payment of 60,000. Okay, that is 60,000 given. Then the share exchange of 200,000. Okay, now when you add up this, the total comes to 998,549. Okay, now to this you need to add the fair value of NCI at acquisition, which is given 225,000. So 225,000, so that will be 149. It comes to 1,233,149. From that we need to deduct the fair value of the net assets, fair value of the net assets of subsidiary company at acquisition, which comes to 850,000. So the goodwill will be 373,149. Okay, so this is the goodwill calculation. Okay, Now in the previous questions, this consideration paid was one single payment. Now in this question, they are given different ways in which the investment is settled. So in that case, so you have to consider different investment, the payment methods to identify the total consideration paid. So consider those payments and identify the fair value of the non-controlling interest, then add up these two totals and deduct the net assets of the subsidiary on the acquisition date. So then the difference will be the goodwill. Okay, so thanks for watching. I will see you soon with another video.